Welcome, everyone. It's Chris Blasi. I'd like to introduce you to our November edition of On the Move. I'm here with my co-host, as always, Rich Checkan. Rich will introduce you to tonight's guest. You're going to find him quite interesting, and I think you're going to find a great conversation, especially in light of what's been transpiring the last couple of weeks in this country. So before we get rolling, there are a few of you who may not know Rich, who haven't been on this webinar before. And just let me give you a little bit of background. Rich serves as the president of Asset Strategies International out of Rockville, Maryland. He's held that role for, I think, close to 24 years now. In that role, not only is he running the day-to-day operations as the senior leader, but he's also quite active in contributing to their monthly newsletter and their weekly market alerts. So he's really got a good pulse on what's going on in the markets and always has a lot to share on these calls. And just a little bit about his background before. He has quite a distinguished career prior to the ASI position. He is a graduate of West Point, and he served as a military officer for 6 years. So quite a commendable background. Rich, good to be with you again tonight.
Always good to be with you, Chris, and thanks for the kind introduction. And on that note, I'll just throw it out there. As far as I'm concerned, I'm super happy to have served. And I heard somebody say today, when they were greeted with thanks for your service, he said, "You're worth it." And I can't think of a better way to respond, to be honest with you. But thanks to all those veterans out there who have served. And I'll take it a step further to all their families, because I know that they have sacrificed along with them in their efforts. So thanks to everyone, especially on this day, but on every day. Chris, my co-host, good friend, 30 years experience in the financial services and technology industries. He's the founder of Neptune Global, and he is the creator of the patented PMC ounce. He's worked with major broker dealers, boutique merchant banking firms. He's been quoted in the Wall Street Journal, Investors Business Daily, Market Watch, TheStreet.com, USA Today, and MSNBC. He's a good friend of ASI's. We work closely together selling his PMC ounce product for instant diversification to anybody who wants to own precious metals and should own precious metals in their portfolio. And, just a good friend. We see eye to eye on a lot of things, and I love spending time with you once a quarter with our friends. And one of those friends is a very interesting gentleman. Many of you know Ted Bauman. I count him as a good friend and colleague over these many years, certainly a trusted one. Ted joined Banyan Hill Publishing in 2013. He is currently serving as the editor of the Bauman Letter, Bauman Daily, the 10X Project, and Alpha Stock Alert. He lives with his family in Atlanta, Georgia, but that's not where he started out. He was born in D.C., Washington, D.C. I call it the Puzzle Palace. He was raised on Maryland's Eastern Shore, and at a young age, he's seeking adventure. He went to South Africa, and he graduated summa cum laude from the University of Cape Town with postgraduate degrees in economics, economic history, and politics. He went ahead and served 25 years in South Africa, primarily as a fund manager for low cost housing developments and projects. One of note was Slum Dwellers International, which has gone on to help over 14 million people in 35 countries. As a consultant and researcher in South Africa, some of his clients were the United Nations, the World Bank, South African government, and European grant-making agencies. In 2008, he returned to the U.S., but and when he did so, he took on the role of Director of International Housing Programs for Habitat for Humanity International. So he's got a long history of working as a researcher, consultant, and has helped a lot of people in this world. He's visited over 80 countries. He's regularly quoted by Barron's, Forbes, Market Watch, The Guardian, and Benzinga, as well as Financial TV. He's got a book, Endless Income, and he co-authored a book, Where to Stash Your Cash Legally, with his father, former Congressman Robert Bauman, from the great state of Maryland. I think Ted shares one of my beliefs that no matter what card you're dealt, no matter where those cards are dealt to you in this world, you have the ability to get whatever you want out of life, to grow your wealth and make all your dreams come true. And I think that comes out in a lot of things he says. And we're super pleased to have you with us here tonight, Ted.
It's a pleasure. It's a pleasure. I'm glad to be here. Yeah, we have not only the ability, but the obligation to do for ourselves, because nobody else will. That's my philosophy.
Amen. Amen. Accountability, responsibility. We need more of it in this world. We're going to kick off right off the bat with probably the one topic that's on everybody's mind. Apparently, I've been told there was an election last week. And although some think the results are in, others contest it and say they're not in, and they're fighting for, to find out what's going on. At this point, officially, we don't have a winner. But we're already seeing some impacts in the markets, et cetera. I'm sure there'll be others depending on which party prevails. Just some of your thoughts on how the current election, the results, contested or otherwise, are going to affect markets going forward.
Well, I think, first of all, I think the markets, and I'll be blunt about this, I don't think the markets think that the election is still contestable. Like it or not, Wall Street is out there to make money for themselves, and as I say, markets are future looking, and I think they've looked at the situation and they feel that what they see on the ground is likely to stick, which means that we will likely see a Biden presidency. We will likely see a Senate that continues to be in the hands of the Republicans, and a House that remains with the Democrats. Now, what that means, I think, in practical terms for the market is that the market does not see the likelihood of fiscal stimulus of a sufficient scale to be able to boost everyday stocks, the stocks that really cater for people, what we call cyclicals, stocks that are really focused on buying and selling the real things that people need every day, things like energy and banking and materials and all that sort of thing. But then something else happened, and that was over this last weekend when we heard that Pfizer had announced the possibility of a vaccine which could potentially get us out of this mess. And what's happened, I think, is that the stock market went from having bet initially on a unified government with Democrats controlling everything, which meant money flowing into the economy, which meant good for cyclical stocks, to saying, okay, no, that's not going to happen, to going, okay, with a vaccine, that's going to be good for cyclical stocks. So what's happened is what they predicted happened, but for the wrong reason, I guess you could say. It happened because of what's happening at the medical level. Now, there are a lot of reasons to think that this is going to take longer than anybody thinks. And as a result, the smart money is saying, let's be cautious. In my note to my readers at Bauman Daily on Tuesday, I said, the number one thing you need to do is keep your feet on the ground and not get too excited about this reversal from technology stocks to cyclical stocks, the everyday stocks, the small caps, and so on, because it'll get reversed. And what happened on Tuesday? Boom, got reversed. Again today, got reversed. Technology stocks were back up again. Fundamentally, what I see happening going forward is that the technology stocks that have benefited for a long time, the big tech companies, they benefited for two reasons. One is because they are providing genuinely useful products. But number two, because they are also impervious to what happens in the real economy. A company like Google, for example, can sell its data on consumers to other companies who want it, regardless of whether we're in a recession or not in a recession. So as a result, the technology companies have been able to do very, very well over the last decade, even though historically speaking, economic growth has been relatively slow. I mean, it has been. We've just not grown at the level that we are used to over the last 10 years. So that has attracted a lot of money to these technology stocks. They're impervious. Growth doesn't matter to them in terms of the real economy. What's happening now is we're starting to see a rotation away from those stocks into stocks that matter for the real economy. I'm very bullish on stocks that are currently undervalued. In my Bauman letter, I'm recommending stocks that have been beaten down because of the pandemic, particularly, for example, real estate investment trusts that own retail centers, not so much malls, but shopping centers, that sort of thing. The time now is to look for value, but that's just because of the vaccine. It's not because of the politics. The politics remain uncertain, but the hope of the vaccine has changed things. So I think right now the big money to be made is not in the stocks that have done well in the last 10 years, and especially this year, but to rotate away from those into the stocks that have been beaten down. And that's what I'm advising my readers to do.
Can I just push back on that a little bit? You know, the markets seem to me incredibly fickle. Okay, everything is sentiment driven.
Yeah.
Do we really see that much of a change of fortunes in just one news item? I mean, the trials went well, great, but it's not out there yet. We don't know if we can actually deliver it right to enough people to make a difference. And even so, is it going to be the panacea that everybody hopes it is? You know, on the news, you saw, I mean, we're being hosted tonight by Zoom. Zoom has done very, very well throughout the pandemic because it helped people transition to being outside of the office, right? And still carrying on with day-to-day business. And then on the news that we had a vaccine, potentially, but not yet, it plummeted because we don't need Zoom anymore. I mean, that's just incredibly fickle to me.
Yeah. No, absolutely. And you're right. I mean, it's a sentiment-driven market. But I think at the level of fundamentals, I'm an economist, so I'm looking at from the perspective of an economist. The stocks that have done well, like the Zooms, are insanely overvalued. I mean, come on, we're looking at price to earnings ratios over 400 in the case of Zoom. I mean, that's just not.
Where can I buy some?
Yeah, well, exactly. You know, so they just cannot. It's like a rocket. When you shoot a rocket up, it gets to a certain level and then it coasts and then it has to come down unless there's something behind it. And I think what's going to happen is that the cumulative sentiment is going to start to turn towards the future. And the future has got to be a revival of the economy, whether that revival comes from spending from the federal government or whether it comes from a cure for COVID or a vaccine. People are going to start betting on that. Now, it's not just about the Pfizer vaccine. There's also a couple of others. There's Moderna that's also coming up. So I think generally speaking, even if it's just based on sentiment, I still think in the short term, at least for the next quarter, it's really got to be about the value stocks and the cyclicals that have been beaten down. But I take your point. So my advice is don't trade on a day-to-day basis. Set up your charts to look at the weekly and monthly flows of investment into different sectors and look at the price performance over a suitably long term. That's the wise thing to do.
Do you know any good newsletters where they can get input like that?
Well, we try to do it in the Bauman letter. And by the way, we've changed the name of our Apple Stock Alert to Profit Switch recently, just so you folks know. I mean, essentially, Profit Switch is it's a more adventurous service that and it has really good gains. We've averaged, I think, over the last 3 months, our average gain on positions that we've sold is 65%. So I think we're doing pretty well.
Gotcha. Now I think everybody's going to have a little bit of chance to get some input here, but I want to throw it to Chris. I know he's chomping at the bit. Talk a little bit about what all this means in the world that we both work in, which is precious metals. And I know, Ted, you have some thoughts on this subject as well. But Chris, your thoughts on precious metals going forward in this undecided environment?
Well, sure. Obviously, there's a couple aspects to this. At the end of the day, the precious metals have been in a long-term bull market, right? It entered a secular bull market back in 2001. It's kind of taken a classic, first leg up, 50% retracement in leg two, which ended in December of 2015. And we've resumed the upward trajectory since then. Now, the one part, what I'd like to say is that when this trajectory started rising again for the third leg, that was January of 2016, that was way before coronavirus. So, the folks that are just fickle, that really don't understand things and just react to news stories and bites, who think that the precious metals went up because of the coronavirus and, some of the stimulus programs to support a dying economy. Well, there is short-term impact to the precious metals pricing, but when you strip that away, there's still there's a market for the metals that have been in a secular bull market driven by fundamentals that are outside of what's in the news right now. Now, we all know what happens in the news on a day-to-day basis is going to affect anything on the short to intermediate term. So I think we would all agree, and I'm sorry if I'm being presumptuous, but we're precious metals. We're physical precious metals people. That is not something that you should be trading in and out of on the short, and even questionable on intermediate terms, depending on your definition of intermediate term. These are the metals serve investors quite well as that ultimate hedge, as that key foundation part of your portfolio. And it's there to serve as that counter to your other positions. And unfortunately, I think some investors lose sight of that sometimes, right? So I think, people were expecting, we're going to get some more stimulus money and silver's going to be $100 an ounce in the next 2 to 3 weeks. And then they're disappointed when it doesn't happen. Does that mean silver is something that you shouldn't be involved in? No, silver is an excellent asset, acquired correctly and held correctly with the right expectations. So to Ted's point, it's a very fickle market. Everyone loves to churn things based on stories. And I think, well, from my position, the stories, they will take the same story and you can spin it to be bullish or bearish on anything. I mean, that's what the spin doctors do, right? So you can spin it where that vaccine is either good for precious metals or bad for precious metals. It's just depending on who's the person, who's feeding you the information. So from the metal side, I think we pull back a little bit, right? The news, everything's going to get better. It may get better, but it's going to take a while. Even if Pfizer is onto something, there's a long gap between that turning everything around and going to pre-coronavirus. There's going to be a lot of carnage in the real economy that Ted talks about over this winter. I mean, it's already happening now. You're watching the New York's locked down hard, right? There's nothing Pfizer is going to do to bail out. And those businesses that are even still around, and I happen to have personal friends who are in the restaurant business in Manhattan, or used to be in the restaurant business in Manhattan. And the few that are there are they can't hang on much longer. And if it's 6 months before, and 6 months, there's no way everyone's going to get vaccinated and cured. And the last thing, to Ted's point on real estate, also have friends that are in the hotel industry, in some of these very chic boutique hotels in New York. Obviously, they're dead. What they're doing now is trying to come up with ways to repurpose those properties and do things. They're coming out with some outlandish ideas. I mean, they're brainstorming because they can't survive. They're down to skeleton crews with occupancy of 10%, and you can't hang on much longer. So great stories about Pfizer and all that, but the 6 months ahead of us are going to be a real test for the real economy.
Yes, they will.
I'll just add on the metal side. You made an excellent point, Chris, that the market did not start moving because of Corona. I believe Corona was the gas or the kerosene on top of the spark that ignited, a big run up earlier this year. But you already documented when the lows were hit, when we started the uptrend back in 2016. The breakout, let's face it, occurred May of 2019, and there was no hint of Corona anywhere in the world other than beer. So the bottom line is the precious metals are moving. They tend to move in long trends, and I don't expect this one to stop. I think you're talking about weak hands versus strong hands. I think the strong hands see the opportunities every time there's a dip in a bull market, and the trick is to figure out when it's a dip in a bull market and when it's a turn back to a bear territory, like we saw in 2011. And there's a number of ways that you can identify that when you see a convergence of factors, but we're not seeing those right now. We're seeing sentiment-driven moves in the market, period.
Let me ask you guys, I got to ask you, another important asset class that is a direct impact on gold especially, what's your opinion on the US dollar and the strength of the dollar going on a go-forward basis, both from what's happening in the real economy and what we're going to see politically, right? Different policy.
You want to start off, Ted, or?
Sure. Well, look, my take is that the dollar is fundamentally a political animal. It's driven by perceptions rather than by fundamentals. Because if it was driven by fundamentals, the number of dollars that exists, if you total up all the different levels of money supply, it should be worth nothing. But it's worth something because it's what everybody trades in. And for me, the key question is anybody going to change that anytime soon? The Chinese have people have been talking about it for a while, but the Chinese are every day shooting themselves in the foot if that's their goal, because they're showing themselves to be more and more and more, or less and less reliable, I guess you could say. They're not a good faith player in global markets, and people are not going to switch from the dollar to the renminbi as a means of global exchange. Now, what that means is that the demand for the dollar will continue to come from sources other than the actual US economy, and that's what artificially keeps the dollar up. I think sentiment and concern about the dollar from the perspective of the you know how the U.S. economy, or rather how the U.S. government is running its accounts. Sure, those things matter, but right now the Fed has essentially said that we will accept any amount of treasury bonds into the deep black hole that we've created, this deep vault where we keep these things, where someday theoretically they'll be paid back. And I think the global market has accepted that they probably never will, and doesn't really matter. They're just theoretical dollars. They're not real dollars.
If you're buying it from yourself, or you're really selling it in the first place.
Well, exactly. And so fundamentally what we're doing, and I hate to use this term, but we are in the midst of an experiment of what some people call modern monetary theory, which is the notion that you can just spend money indefinitely as long as you have loose conditions in labor and capital markets, and that's pretty much what's happening. Anyway, so my thing is, I think the real question depends not on how much money is being put into the markets at a sort of theoretical level, but how much money is actually going to real people at a practical level. If I can, I want to try to share a chart that I think is really striking. Are you guys ready for this? I'm going to try to share a chart with you.
Let's
This
see
is
it.
something, here we go.
I have full faith in you, Ted.
Are we seeing it? The chart?
Not as of yet.
All right, here we are. Here we go. Let me share it.
Now
You should be. So essentially
Yeah.
what this chart shows is the relationship between the gold price since 1970 with M2 per capita, which is essentially the broad money supply, the money that ordinary people in the world actually have access to. And then the gray line is the 10-year yield on treasury bonds. Now, what you can see pretty clearly is that there are two things at work here. One is that the relationship between M2 and the gold price, I think, is pretty strong, with the exception of that little bit in the red rectangle, which I'm going to talk about in a moment. But the other thing is that the gradual decline in real interest rates, which are basically the interest rate on a 10-year treasury, less inflation, is also an important factor. But the key thing is, I think that it's the perception that M2 money supply, the amount of money that people have in their pockets to spend, is really drives a lot of sentiment in the gold market. The difference, I think, was that early spike in the early 2000s or the early 2010s, when a lot of it was really driven more by the interest rate issue. And if you look at that huge decline in the gray line from about, I guess, the beginning of 2009 down to its lows in 2011, that was the expectation. I think that people realized that gold was an alternative to low bond yields. People thought, if real yields on bonds are going to be below zero, then why hold them? I want to own gold. And that's why that thing shot up. But then when real yields began to increase again a little bit during mid-decade, you saw that back down. What's driving it now is the combination of the low interest rates plus this M2 money supply increase. Now, my point in looking at all this is that I think that the dynamics of the situation are such that we can expect expectations of dollar weakness and expectations of M2 money supply growth to continue to push the gold price up. But it's not going to happen in a straight line. One of the things that happens in these kind of situations, like we saw this week, is that when people see opportunities in equity markets, they want to liquidate gold holdings so they can jump back into equities. And I think that's what we're going to continue to see. And there's always this perverse thing that happens that when there's a crisis, everybody thinks gold's going to go up, but instead it goes down initially because everybody wants to, liquidity to be able to buy stocks. And I think that's what we're going to see. But for me, the trend is bullish. But to go back to what you said, Rich, that shouldn't matter to a smart gold investor. We buy gold because it stabilizes our portfolios. It keeps our portfolios with a chunk of it that is not going to change over time relative to inflation. If you want to speculate in the gold markets, you need a PhD in gold speculation, which I don't have. I can't do it. I think the average investor is best off identifying a target percentage of their portfolio, buying it, and just leaving it alone.
Yeah, no, that's a good point. And gold's role is, again, I think, long term, and that's what we've sold gold for 38 years now, is that wealth insurance for your portfolio. And it seems odd, everybody that I talk to says, I want gold for insurance, right? But in reality, they want both. They want to own it for insurance, but they want to see their insurance policy's value increase in cash value over the years. So they want profit too. And the reality, most folks are somewhere on that spectrum, and they lean toward what's most important. I think there's an element of both. The beautiful part about gold is you can own it, say 10%, as wealth insurance in your portfolio, and you really don't want to see it climb in value, although it will from time to time, because if it doesn't, chances are 90% of your portfolio is doing just fine, right? And it's a tough concept for people to grab onto. I still think you can profit in the short term in bull markets with gold and silver, but you have to look for some key areas. And I'll touch on them a little bit. I want to go back to Chris here real quick. Your thoughts?
Well, yeah,
Dollar.
but even if you look at the chart and the times the golds were spiking up, what was going on? Bad things, right? So that goes to the point when you say to people, I'd like to see gold gradually rise, not spectacularly, because when you look at those spectacular spikes, what was going on? Coronavirus came and the economy was getting crushed. Back leading up to the financial crisis of 2008, the gold market knew what was coming, right? So it was telling us we had trouble coming, because it wasn't buying into what the economy was being driven in 2005, 6, 7, and 8. So the point is, yeah, it thrives when things are chaotic. And when things are chaotic, that's generally, not good for just our day-to-day living. So I would suggest to folks, I know if you own some gold, you want to see it at 5,000 an ounce and 10,000 an ounce, and some of the numbers that some folks have said. And it doesn't mean that won't happen maybe over a long period of time. And it could happen on a short period of time with a very dramatic event. But I don't think you really want that, right? Because what those events and those times mean are big trouble on the other side. Because if you have a hedge for that, it's hedging, trouble. So, but people need not to lose, don't be impatient. And I guess really when it comes to precious metals, because they've done what they've done for so long, it's unlike an operating company and you're buying their stock and an industry disappears. Don't overthink it. I mean, don't overthink what gold does, right? And I think some people do. They want to, it's like, it is what it is. It's financial insurance with a unblemished track record for 5,000 years. And to a lesser, it's 3 other companion metals. So my point is, I think we're going to be in for some continued rocky, volatile times. So I think you definitely need it. Ted concurs that, net, he's still bullish on it. Mm-hmm. Don't get thrown off by a short-term move. I mean, that's how you spook an investor out of the right position. Don't get spooked. Don't let them get in your heads and scare you out and thinking that like gold was going before coronavirus and before Pfizer. So Pfizer coming up with a cure coronavirus doesn't make gold an unnecessary component of your portfolio.
I want to add 2 quick thoughts here if I could. First one is, we were open for business when the planes went into the World Trade Center, okay? Spent the majority of that day talking to clients, telling them, don't buy gold today. If you remember, it spiked up like $50, $75 an ounce in one day. That was a big move back then. And our objective all day was to not do a trade. right? Because I'm not taking care of people if they buy on that spike. And within a week, it was right back down to where it started from. Okay, that is not the reason to buy gold. The other thing is, I caution people when they call up and they say, well, I want to buy it, but it's 1860. I'm really looking for it at 1850. Come on. If $10 in gold's price is the difference between you owning it and not owning it, you're buying it for all the wrong reasons. Don't buy it in the first place. Okay, you really have to look long term. You don't get wrapped up in short-term sentiment when it comes to gold.
And just to add to that, you can't market time. First of all, market timing stocks, very difficult. Market timing precious metals, that's a whole nother league of difficulty.
Yeah. You need a PhD is what I said earlier.
Exactly. That's why, you said it before, so I know I could say that and be in good company. And all I would say is, look, I believe gold will continue to go higher. And do I think it can be 3,000 an ounce in 2 years or something? And would that, because of that, would that make a good component for my portfolio? Yes. So if you believe it's going to, in the next several years, to a number that's higher from where we are now, don't get caught up in the $10 entry point. Like you said, does it really matter 1850, 1840? Because if the trend is generally up, if you wait, you're more likely to have to buy it higher. But I would, don't mark, just say, if your research tells you this is right for me, I've determined I need it, then you're better off just executing on it.
Now, the way I look at gold, gold is the canned soup in your bunker. Under normal times, it's just there. But when things get tough, everybody wants that canned soup, and they're going to pay top dollar for it. And that's really what gold's role is. You don't worry about the price of your canned soup on a day-to-day basis. You just know it's there. It's there for you when you need it. And I think that's how people should look at gold. As a naturalized South African, my advice would be that if you really want to play the gold market in an interesting way, look at gold miners. I mean, earlier this year, my Bauman letter bought one of the ETFs that holds the senior gold miners, and they outperformed the gold itself by quite a substantial amount. Then they pulled back again because there's a whole different dynamic in the gold mining market as opposed to gold itself. But really, the thing is, as you say, don't treat gold as something that you trade in and out of. You don't trade in and out of, a gold bar that weighs a kilogram. You put it in the safe and you leave it in there like the canned soup. And that's how physical gold should be treated. If you really want to play around in the speculative market, play the miners. I think the miners are where, we made 35% in I think 6 weeks on the miners. Simply because it goes with a different dynamic, and it's one that stock investors can legitimately play without having to worry about these day-to-day swings.
That's a good point. Now, I got a couple of thoughts I want to add on to that, but before I do, I just want to remind all our listeners, and we got a bunch of them out there tonight. To me, the real value of this webinar is not listening to us talk about what we think you want to hear about. The real value is your opportunity to ask us what's on your mind. There is a Q&A button. I think everybody's probably familiar with Zoom at this point, if they didn't sell it off on Monday. But the bottom line is, ask us your questions. We want to hear what's on your mind so we can touch on that. We're going to get there here shortly. I have mining stocks in my portfolio too. I think they're a great way to get a leveraged return on any movement in the gold, silver, platinum, palladium market, and that's wonderful. The one word of caution is, when I first got here 25 years ago, I can't tell you how many calls I took where, people said, oh yeah, I got gold. I've got 5% or 10% in my portfolio. I'm like, great, how do you hold it? And they said, well, I got Newmont Mining. To me, that is not gold ownership. Okay, right. You own shares in a company whose job it is to mine gold profitably and hopefully return that profit to shareholders. But you got a lot of other variables too, right? You got management, you got the reserves, you got environmental issues, you got indigenous personnel issues, you got all sorts of factors that could affect that, even if gold's going up, right? And I forget the name of the stock, but we held one in 2001. It was poised. It followed Newmont's lead. It had, deleveraged. It had proven reserves, proven management, Gold shot up in 2001 and its price went through the floorboards and never recovered to this day because the mine flooded. And they had all sorts of environmental issues they still have not dealt with. So just keep in mind, it's out of an equities allocation. If you're going to own mining stocks, your insurance for gold, you set it aside, you never touch it unless you need it. And if you never need it, good for you.
Yeah, I think that my point about gold mining stocks is that if you want to exercise your animal spirits around gold, do it in that space. Don't do it with gold itself. And as you say, I think one of the critical things is that people make a killing sometimes on junior miners on the basis of rumors about new deposits and that sort of thing. Entertain yourself with that stuff. Just don't do it with your actual physical gold holdings. Buy them and keep them.
Gotcha. You want to add some thoughts, Chris, as well, before we move on to some Q&A? Because thank you, folks. You are sending in the questions, and we're going to get to them.
Well, I'll just say one thing. We talked about gold, and I don't think the other precious metals should be neglected, because I'm sure a lot of our listeners tonight are probably owners of silver and or are considering silver, right? And silver is, we know, that quasi metal, it's part like a monetary metal, which is what gold is, and it's an industrial metal. And we have two other minor players, platinum and palladium. So I have to say, because you brought it up in the beginning, if from our perspective at Neptune, if you want to get even more savvy in the world of physical metals, the PMC ounce has been in the market since 2008, long track record, and it was architected and weighted in a way that it gives a superior risk-adjusted return. It was proved it out mathematically with the Sortino ratio and other things that portfolio managers will use, and it's continued to do that. So our position is it's a true physical metals position. It's all backed 100% by gold, silver, platinum, palladium, and it's turnkey. And as I said before, don't outthink or don't overthink. If you want the diversified position for a better risk-adjusted return, and you want an allocation, it's predominantly in gold based on the amount of money on the percentage of the dollars going into it. It's got a big position of silver, and there's some platinum and palladium. And I can tell you, those positions in platinum and palladium make an enormous impact overall to the product's performance. So, people could always visit our website, look at the homepage, shows the performance chart of the PMC ounce. You'll see it's quite handily outperformed. And as Rich mentioned, Rich is a dealer who also transacts in the PMC ounce as a product for their clients. So,
yeah, both the personal funds and IRA funds. So you can own it two different ways, and it's physical backing of all the metals. And like I deemed it earlier, it's instant diversification. So as Chris said, you don't have to overthink it. It kind of touched on a little bit of silver, which is one of the questions that I saw here from one of our attendees. Basically said, what do you think about silver long-term in your portfolio, not just gold long-term? Anybody want to touch on that other than in the PMC ounce?
I'll just say, if you need a PhD to trade gold, what's an advanced PhD? It's
postdoc. I think they call it a postdoc
maker, right? No, silver is obviously it's a very volatile metal. Offers tremendous upside. You have to have the stomach for it and understand what you're going into. Do I believe it's got a good future going forward? Yes, it's an industrial metal that is used in applications in all high growth industries. So it's not like, you're an industrial metal, but you're in a passe product group. Heavily, it's all in the electronics and technology and obviously solar panels. So it's all good, but it's a volatile metal. It's a much smaller market than the gold market, which, gives it that level of volatility. People don't realize that the amount traded of silver is much smaller than gold, but I believe it has a bright future. And again, we made a turnkey way to own it, but as an individual on its own, yes, I think it's good going forward, but just beware of what you're getting into. And if you're following an analyst or a promoter who is telling you about silver at, $250 an ounce in the next 8-9 months, I think silver will be higher, but just be level-headed about it.
Amen. Anything to add to that, Ted, or you want to look at another question here?
Well, I'm definitely not a silver market expert for precisely the reason that you do need a postdoctoral degree. But I see one question that's asking about U.S. markets and valuations versus developed country markets, and I want to address that because that's something that we at the Bauman Letter are really diving into headlong. I think that is exactly the right thing to look at. We have to look at price to earnings ratios from an equity perspective. If that's what you're trying to do right now to make money in equities, right now I think technology stocks are overvalued. They are badly overvalued, even if they have to catch up to their valuations. And as I said earlier, the reason why U.S. technology stocks have done so well is because relative to the rest of the market, they've been the only game in town. And so money has flowed to them. When money flows into a stock, it drives the price up, whether it's worth it or not. Right now, you're right. I mean, you can get companies with good earnings at half the price per dollar of earnings in foreign markets that you can get in the United States. Excellent companies. We've invested in companies in Brazil, in China. We've invested, in the Bauman Letter in companies that are literally half the price of their peers in the United States on a price to earnings ratio. And the great thing is that if you buy them now when the dollar is relatively strong, the dollar weakens in the future and those earnings in their home currency terms rise relative to the dollar, and that gives you an even better return. So absolutely, I agree. Look offshore. Offshore is gold when it comes to equities right now. That's my philosophy.
So it's like buying Nestle's when there was 4 Swiss francs to the dollar, right?
Yeah, exactly. It's basically you want to try to get into them when you're at an advantageous perspective from a currency perspective, but also just looking at what the companies are likely to do and how cheap they are relative to the dollar or relative to U.S. companies.
All right, we haven't touched on it tonight, but one of the questions I saw was any thoughts on cryptocurrencies? I have some, but go ahead.
My thoughts on cryptos, I have a hard time getting my head around them. It's a purely speculative market in a purely speculative asset that really doesn't have any, practical application really other than the blockchain technologies themselves, which is a different market. I myself don't invest in Bitcoin or any of the other cryptos. I have not developed expertise in it. And I think that's the real issue there is that it's one of those markets where you really need to know what's going on because people have taken a serious bath a couple of times on Bitcoin, for example. Sure, it goes up, but it also goes down. And knowing when those are going to happen, I don't think anybody's worked out when that happens. There's no predictability, so I stay away from it myself.
My thoughts on crypto are this. When it first came out, I thought, and I still think to this day, that everybody swore up and down, the purists, that it was strictly anonymous. There's no way that the government could shut it down, et cetera. I'm telling you, if the government wants to shut it down, if it wasn't any more annoying than a gnat on their windshield, they would have squashed it like a bug. Okay, because the power I think that the government has over their citizens are the money, right? That's what they control, and that's the control they have. So I don't think they're going to release that control to private industry, although deep down I'd love private industry to get hold currencies because I think they do a much better job of managing them. But that's the libertarian slant, right? Now that they've gotten a little bit of, backing behind them, you start seeing news articles come out where the government's clamping down because they're opening up accounts and transferring assets across borders just on emails without the proper anti-money laundering protections in place. So you're starting to see more of that happening. I do think the governments are looking hard at adopting the blockchain and cryptocurrency for their centralized currency options. So the bottom line is I think it's got a place. I really love the blockchain technology and those applications, because I think in a world where peer-to-peer is the way everything is trying to go, I think the blockchain is the answer to all of that with any sort of, trust in those relationships. The one thing I do love about crypto, and it's come out through a couple panels I've been on, gold versus crypto, is, for me, gold is real money, right? In my personal opinion, what I've seen for millennials, crypto is real money. They feel like everything else has let them down, right? And I hear things from millennials where they say they were attracted to crypto, they were intrigued by it, and there they learned Austrian School of Economics. If that's what happens, that alone is worth keeping crypto around for a while.
But my only pushback to that, I'll leave aside the Austrian economics, but for me, the big question that always comes up in my mind is what happens when the electricity goes on? Which would you rather have?
Yeah.
Bitcoin or gold?
Yeah. No question about it. And I think there's a reason that when we talk about allocations, it's 10% typically for most people, not everybody, but 10% gold allocation for wealth insurance and a 1% allocation to cryptos. When I hear 1% allocation, there's only one word that comes to mind: speculation.
Yeah, absolutely.
So I just have to say, I got to chime in. To me, the thing that I take, takes me aback is there's a lot of misuse of terms and not understanding, conflating things with some of the underlying technology with the product. Ted talked about it before. I mean, they'll use the term, blockchain, or how about distributed ledger? Distributed ledger, that's an old technology. When I was in the tech business, there was distributed ledgers back in the 90s, right? It's just a way of distributing data across, drives and stuff like that, as opposed to, but people, they run around and say, oh, it's got a distributed ledger, right? You shouldn't be investing in something if you don't really understand what it is, right? Especially something that is backed by absolutely nothing, right? If a person says the US dollar is backed by nothing, that's not true. You have the US military and you have all the might that the country has to make sure that, it keeps its position and all its political clout, as Ted said, because no one else is offering a better alternative. And what people thought maybe China was a couple of years ago, well, China's behavior, well, that's now they're kind of losing that. So crypto doesn't have that. And at the end of the day, if you have to surface and use the internet to do your business, you're in a highly vulnerable position. And, and when people talk about it's not hackable and all that, yeah, it's not hackable for some small time guy in his basement. You do not know the capabilities, the compute capabilities of sovereigns, right? That the NSA has and all that. So that's just, what are you talking about? You don't know what they're able to do. You don't even know what they're doing. So don't think of what your friend does in a data center is their capabilities. And also, and here's a real world example. What was it 2 years ago when everyone got those letters from the IRS who had been buying and selling Bitcoin and other cryptos? How did the IRS know? I thought it was anonymous. Well, they had to go to the exchanges to do their business, and the exchanges gave the names of all the people. So my point is, look, be realistic. You're competing with the government who issue money. Right now, to Rich's point, it's a fly speck on their windshield. You start threatening their position, and you're going to see the gloves come off. Yeah. And I would love it to be if we could all create private currencies and all that and have that level of freedom. But the realistic side of me says not going to happen.
Yeah, that's a good point, Chris. Glenn Kirsch, who founded this company with Michael Checkan, always used to say, you never want to fight the government. They have all the time in the world and all your money.
And all your money to do it.
So moving on to the next question. One of the attendees asked about deflationary versus inflationary pressures, and will the deflationary forces of the technology sector thwart the Fed's effort to force inflation? Any thoughts?
Well, I think in fact, I read an article just before we came online today, a very, very long article by a brilliant writer named Lynn Alden, who I follow on Seeking Alpha. And she talked about the conditions under which you face inflationary versus deflationary tendencies in the economy. I think we are fundamentally in a deflationary economic environment for a couple of reasons. One is obviously because we have constrained demand because of COVID, but the other is because we still have debt issues. I mean, we still have historically high levels of debt to GDP, not only in the public sector, but in the private sector, and even at the household level. And the things that people resort to debt for, like education, healthcare, and housing, are all continuing to rise in price for essentially non-market reasons. I think, you know, there are inefficiencies in those markets, and that pushes people into more debt relative to what free markets would provide. And for that reason, I think people are going to be hesitant to spend money, and that's deflationary by definition. The same thing goes for business investment. Businesses are not willing to invest. Why on earth would you invest in new capacity right now under these circumstances? If you're a real world economy business, you won't do it. So this is a deflationary scenario. The question in particular that was asked was about the technology sector leading to deflation. Yes, I think that does contribute to it in the sense that technology leads to higher productivity, which means lower priced goods. But that should allow people to spend more money on other goods that are not amenable to technology to reduce their prices. So net, it should not be the main driver. The main driver for me, call me old-fashioned, even call me a Keynesian, if people don't have money to spend, whether they are individual households or businesses, you will not get inflation. They have to have money to spend on things, and there has to be a shortage of those things in order to have inflation. And right now, I don't see that on the horizon in the near future.
That's a good point. You know, we were talking before we jumped on air here, and I fully believe that part of what you're seeing in the inflated stock market valuations is where the money was doled out last crisis, right? 2008, 2009, it went to the banks, went to the brokerages. And not a surprise to me to see the stock market at the dizzying levels it's at, because that's where the money went. It was not put in the hands of consumers. We started doing that this time with the PPP going to small businesses with $1,200 checks to how many million people. So there's the potential there, but I agree with you, not in this environment. There was another question asked about holding silver long-term in a 401k and then converting over to physical. Unless you guys have another solution, I don't know that that's even possible. You know, the problem with 401ks and other vehicles like that are they're very constrained, right? You only have a very finite number of choices to make, and usually owning physical precious metals is not one of them. Really the only way to get that into some sort of physical silver holding is if you have a reason, a qualifying event that allows you to roll it into an IRA where you have much more flexibility and so many more options. Okay, so in a 401k, you're probably relegated to, if they even offer it, you know, an SLV or something like that, which is, in my opinion, not anywhere near the same as gold ownership or silver ownership.
Yeah, I'm a big fan of self-directed IRAs, by the way. And I think that is one way you can do that. So yes, I think you're exactly right. If you're really concerned about it, then see if you can roll it over. But as you say, even if you have a self-directed option, like a brokerage option in your 401k, you're only going to be able to trade in the ETFs, and that's not really going to help you.
Gotcha. So two more questions. And just so you all know, I want you to stick around to the end because everybody's going to have a final parting comment after we're done with the questions. And I hope we don't go until tomorrow. But I'm a firm believer, as Chris knows, that if you're asking a question of them, just please bear with us. The one client asked, Jim Rickard's talking about gold going to $15,000 an ounce sooner rather than later, and you know, is that directly impacted by MMT? Is that a disaster waiting to happen? I personally have much more realistic expectations. I'm not saying that his expectations are unrealistic. It's just I don't see that big life-altering event where all of a sudden gold is worth $15,000. I think we're going to engineer something where that the governments are going to engineer something where that doesn't happen. But what are your thoughts?
Well, let me address the MMT part of it, because I did raise this earlier. I mean, MMT, basically modern monetary theory, is to my mind, is actually a fairly accurate representation of what's happening right now, which is the notion that the government really can afford to create new money and spend money as long as there's slack demand, or rather, put it this way, as long as there is excessive capacity in the economy, labor, capital, raw materials. Because you only see inflation when you are starting to run up against physical boundaries to real production. Now, obviously, there can be those boundaries in specific sectors, so you can get inflation, for example, in agricultural commodities because of the weather, but that's not caused by money printing. That's caused by, just natural variability. But for me, I think that I don't think MMT itself, or something like MMT, is going to lead to inflation. For precisely the reason that the people, that the people who push it say, we are doing it right now. That's what I would say to the people, a person who asked the question. We are doing MMT right now. The federal government borrowed money from the Treasury. The Treasury bought, or effectively bought, Treasury bonds, which allowed the government to send out the biggest stimulus we have seen, really, in U.S. government history in terms of direct stimulus. And we have seen a very moderate impact on inflation. And that includes the sentiment of foreign markets. Foreign markets don't think that's going to lead to inflation. It goes back to what I said earlier. People trade dollars and buy dollars and demand dollars because that's the currency of global trade. So my sense is that the notion that just simply the Fed doing what it does is going to send gold to $15,000, absolutely not. I disagree fundamentally with Jim Rickards on that. What will send gold to $15,000 if we have a serious collapse of some kind of issues of public order, if the pandemic spirals out of control, if you have natural disasters, war, etc., but not because of the money printing. The Fed has a big dark dungeon where it can absorb as many treasury bills as it wants. And at the end of the day, I think people are willing to let that go.
I've got just one quick comment. I'll hand it off to Chris if you want to add to that. But Sharon just gave a dissenting opinion. I don't know if you guys saw that pop up. She's like, you say there's no inflation, but ammo prices have gone through the roof. And I saw that too, the week prior to the election. So,
well, I think that I made the point about agricultural commodities, but it all comes down, to what time frame you're talking about. If the capacity to produce ammo falls short of the demand for ammo, then yes, you got a problem. If it's just that there isn't enough ammo on the shelves right now to meet demand, it'll be sorted out next week.
Chris, anything to add to that point?
Back to Jim, because really the question was about Jim Rickards.
Yeah.
I mean, he's a well-researched. He puts out some very good arguments. He's been correct on trends that have been going on for
no question,
a decade or so. When he says sooner rather than later, again, I don't know what the definition of sooner is in that time frame. I would think there would have to be some sort of very catastrophic event of some way, shape, or form to get a really rapid move up. And I think, not to belabor it, let's hope that doesn't happen because that would mean something pretty terrible. But the whole thing about the printing money, I mean, the money printing has been going on for a long, long time. It's just accelerated under coronavirus. And I think we've all learned is that the impact is muted because of really how that money is distributed, who it goes to. It doesn't really trickle into Main Street. Even with the money of the coronavirus, it was big, but a lot of it went to bigger companies, didn't go to really mom and pop who ran out to, to the supermarket and spent it. Also, there was massive deflationary forces that they've been fending off for years now. So, and I think you said her name was Sharon. There's inflation and deflation, and it's not right now. It's not uniform. With what's going on in coronavirus, there's massive deflation in Manhattan real estate, and there's inflation in suburban New Jersey real estate. Just because all it is you're taking it from one bucket and putting it in the other. This guy's loss is this guy's gain. So, you know, there's a situational situation when it comes to inflation, right? For years, there was deflation in certain industries, right? Car companies, well, you really look what you're paying for a new car compared to what you paid 20 years ago, not much inflation, but healthcare and education, it was off the charts with the inflation. So because there's so much management, centralized management in this country, right? You get all these malinvestments and it isn't a true free market. And this is why you don't have an across the board inflation or deflation, because when you're managing things, this is why you have certain areas with ridiculous inflation, like colleges. And then you have deflation in items like, you know, computers, you know, desktops. And so we have this very almost like schizophrenic market, right? But this is what you get when you invite and you say to the government, manage everything, control this, pick winners, pick losers. That's what they've been doing. All the bailouts, they pick winners and losers. So, you know, unfortunately, we've moved to I won't say, you know, a somewhat centralized, centrally managed economy. And at the end of the day, I think only the pizzeria guy is the only guy who's truly free market anymore. I mean, truly free market. Everyone else, you know, they got rid of all the small mom and pop shops. So now it's the CVS's of the world. It's always chains. It's always big companies. So, you know, we're in you know, going down a path, which is why I think it's hard to make, to pick what a lot of the metrics we used in the past to determine what's a good time to go into a stock, what's a fairly priced stock, doesn't work anymore. And I think people know that. Most of the fundamental analysts on Wall Street are completely washed out. They're gone. There's no one listens to them. I don't even know if they're employed anymore, right? Because it doesn't mean anything, right? Zoom, as you said, is got a PE of whatever, and then you have a perfectly viable company with a solid, you know, just grinds out a 5% year growth and no one's interested in them, right? And they pay a dividend. So even our investors aren't looking for, you know, just good stability. You know, people are looking for just big hits right away. So it's a very schizophrenic economy and market.
All right, so the economy is schizophrenic, it's fickle, and a few other choice words I'm sure we can't share on the air.
It's just,
So,
yeah, that's all.
So one of our attendees is asking, all right, given that backdrop, which president, when it all said and done, is going to be better, say, for equities or for precious metals? Any quick thoughts there?
Well, I'll tackle that. But I think, frankly, that if President Trump were to somehow try to force the issue from this point and try to, retain the presidency, given everything we know, that would probably be good for precious metals, because I think the global perception would be that would represent instability in the U.S. political system. And again, I'm just talking, I just tell it like I see it. It's not about my politics. I just see the numbers. I see what's happening. The content of the objections to the various vote counting processes around the country. And honestly, if there were some way that President Trump were able to turn this into him remaining into office, I think the rest of the world would take that as a sign of tremendous instability in the U.S. government. That would be very bullish for gold, because it'd be very bad for the dollar. It's not what I like. It's just what I think is real. On the other hand, I think a Biden presidency would probably be bullish for equities, simply because the perception would be that at some point, if not now, then eventually the federal government would probably try to pump money into the economy, for better or for worse. That would at least be good for the cyclical part of the economy, would tend to push valuations up for the companies that have been down for the last while. But again, I'm looking at it from the perspective of the very dispassionate way that Wall Street looks at these things. I read the Wall Street stuff every single day of my life. I read all the sites. They do not care at the end of the day who is president. They only care about what's good for whatever markets they're invested in. And what I just gave you is my reading of the way they would react to that scenario. Trump, good for gold. Biden, good for equities.
I'll counter that. When Trump was elected in 2016, gold was on a run. And then after he was elected, it fell off a cliff. Okay. So I reached out to a bunch of folks in the industry to say, why is it that gold just ceased work, if you will, when, Trump was elected? And I'm not saying this is my theory, but I'm going to watch it and see what happens. One of my colleagues said this, that Democrats don't buy gold, libertarians can't afford gold, and Republicans buy gold when they're scared. Okay. So given that scenario, if he's right, gold should shoot up in a Biden presidency from all the scared Republicans, right? Now, we'll see if that plays out or not. I will tell you that I know plenty of Democrats, Republicans, and libertarians that all own plenty of gold. So already his theory is a little discredited.
Well, my only response to that would be to say that the U.S. market, and particularly U.S. Republicans, don't set the global gold price.
True.
It's about what the world is thinking, and I think we have to keep in mind that the world watches our behavior as the custodian of the global reserve currency, and is very concerned when we see the kind of instability that we have. The circumstances of the election in 2020 are very different. That was fair and square. Trump won fair and square. Equity markets immediately recognized the opportunity. They went up. And I think part of the reason why gold went down was because people saw gains.
Money.
Oh, they saw yields. They saw yields in equities, and then so they took their money out of gold, they put it in equities. What I'm saying is that under the current circumstances, with the nature of this election, it would be highly unlikely to be a commonly accepted outcome if the president returns or remains in office, and that would, I think, put a lot of pressure on equities and push up the gold price.
Good point.
But again, as you say, Democrats maybe don't buy gold, but they don't drive global gold prices.
True. Chris, any thoughts?
I just would say a very good point. Precious metals are truly global. We forget that here. And I think people forget and think only drivers from the US are what's going to propel gold.
Right.
So, we
Solid point.
all need to step back and realize, and since it's an item in limited supply, other parts of the globe can soak it up and drive the price up here, regardless of what's happening here. So also, I'm not going to get into politics or one side or the other. We do have, from a long-term perspective, we obviously have a very divided country that does not appear to be coming together. And I don't think, it doesn't look like it's going to come together in the foreseeable future. So that is, of course, in an unfortunate way, bullish for gold, right? So it thrives in chaos, and a divided nation usually has a bumpy road in front of it, a rocky road. So we'll see what happens.
So I'm going to jump on 3 questions altogether. So one attendee asked, are gold coins as good as owning gold bars? Another one asked, what about gold and silver jewelry for disaster insurance? Another one asked about the best way to own gold. And another one still asked about allocations. So I'm going to kind of throw all them in together. I'll tell you, gold coins, gold bars, both wonderful. Okay, no question about it. It really comes down to a matter of preference. A gold coin is real, a gold bar is real. I heard the argument for many years about buying gold coins because they are more liquid. 25 years, I've never had a problem buying or selling a gold bar. So that seems pretty damn liquid to me as well. What I try to look at is the spreads, see if they make sense. If I've got to pay a huge markup to buy something and it's not supported when I go to sell it back, then I look for a different vehicle. But the spreads on gold coins and gold bars are still relatively intact, which moves me to gold and silver jewelry for disaster insurance. And a lot of the world does wear their wealth, right? Because they don't trust banks, they don't trust governments. So they rather put their money into their jewelry. They can get the pleasure of wearing it, but it's also a store of value for the future. The only problem is I don't look at that as my first choice for disaster insurance because of the premiums involved. I mean, the markups on jewelry are ungodly. If it could be a nice add-on, but it's not your first shot. And the best way to own gold, to me, I buy it for two reasons. I buy it first and foremost, that wealth insurance, the allocation. I think a lot of people come together on 10%, and it's around a number of 8%, where a lot of studies indicate that having it in your portfolio in that allocation, regardless of the makeup of your portfolio, actually enhances overall portfolio performance, decreases overall portfolio risk. So it's kind of a sweet spot. Having more, not so good. Having less, not so good. So that's your wealth insurance number. And a lot of people just go to 10% like we do because the math is easier than figuring out 8%. So that's where that comes from. The best way to own it is whatever you're the most comfortable with. I suggest you start out taking delivery close at hand, holding it somewhere close so it can be that immediate disaster insurance you need if necessary. And anything over and above what you think you might need in the short term, or what you feel comfortable storing and safeguarding yourself, put it in the hands of the professionals. Get it in a storage facility. The more you could diversify, the better. We love the three-legged stool analogy. It's a stable platform, unlike a two-legged or one-legged stool. You don't want to have all your assets in any one country, in any one currency, or in any one asset class or investment. Anybody want to jump on those 4 questions and add anything to it?
Well, just
Okay.
jewelry is way marked up in the US. I mean, also it's a little bit different, the jewelry in India, you know, it's all 24 karat jewelry. It's fabricated different. You go into a jewelry store in the US, I don't know what the markup is, how many hundreds of percentage, but you're paying for their, you know, the services to actually craft the item, which really is going to, you know, gold would have to go up tremendously, you know, to make up for that. So that's why you're better off with the coins and bars. I concur. Coins and bars, the same thing. They're just different forms. It depends on your circumstances and situation. A real quick example, if it's in an IRA, you know, and it's just going to sit there and eventually you're going to sell it in that IRA, I would probably say you definitely want to be in bars with the lower, because bars have lower premiums than coins. Why would you be paying a premium for a US Eagle on, you know, and there is a time when I think the US Eagle is appropriate and the higher premium makes sense. But of course, these differences are small. They're not great. And at the end of the day, it's not one is better than the other, is one's the wrong answer.
Ted, you were going to say something?
I did see one question about what do we see happening to precious metals when the US government goes cashless? I'll just say this, it'll be since you won't have that, you know, that last option of going to the bank and taking your cash out, which is an option we all have, but no one does because we always know it's there. Yeah. If we go pure cashless, like a lot of folks are predicting, it'll be the last form of money that you could actually have in your possession.
It will be the new cash.
It will be the new cash. So I couldn't imagine it being anything but very positive for the metals. Yeah. Because another competitor is off the table.
Yeah. I'm going to throw a couple at your way, Ted, if I could. Sure. One attendee asked, do you believe that going forward, earnings will catch valuations based on Goldman and JPM valuations? It seems P ratios will be in 25 to 30 range, much higher than historical average of 15. And along with that, I want to also throw out our rising stock market / housing reflecting inflation.
Let me answer the second one first.
Okay.
Yes, I think rising stock markets are absolutely inflecting or reflecting inflation, precisely because what people almost to a person fail to recognize is that pumping money into financial markets causes inflation in asset prices. The only inflation that seems to matter to most people is inflation in consumer goods. When it comes to asset markets, it's just rising prices, and good for us. but it's inflation, folks. The Fed has driven inflation in asset markets for a decade,
Yes.
and that is exactly what we've seen. I think we're seeing it in housing markets indirectly in the sense of low interest rates driving the increase in the price of housing because the relationship between interest rates and housing. So fundamentally, yes, we have inflation in asset markets. And to go back to, I think, something that Chris said earlier about the way that money flows makes a huge difference. When the Fed releases money into the economy, the institutional mechanisms that it uses to do that make all the difference to where inflation shows up. The institutional mechanisms that are available to the Fed, that are legal, that are acceptable, that can bypass Washington, D.C., all go into asset markets. And that's why we've seen inflation in asset markets. That's why we see PE ratios of 30, 35% above, or 30 and 35 compared to long-term historical ratio. So yes, I think that's a critical lesson to learn.
Can I just add to that before you go on to the first question second? Ben Bernanke got up after an FOMC meeting in a Q&A session shortly after the financial crisis. And I'm going to paraphrase here because I don't have the quote in front of me, but he said that the goal was to make people feel like they were wealthier. So their stock market or their stock portfolio looked better, or their 401k looked better. Their house price was increasing in value. And if we created that feeling of wealth, then they would be more apt to go out, spend money to give the companies they needed to hire and produce more. Okay. This is the game plan. He said it. And everybody's been playing it out for years. So yes, there's no question. This has all been about increasing asset value so people feel wealthier. It doesn't matter if you are or not.
Well, exactly. But the problem is that less than 50% of Americans actually own stocks in any meaningful way. And the vast majority of stocks are owned by about 5% of the population.
I think I know where the divide is coming in here, by the way.
So if they need to be made to feel better about their financial situation to get them to spend, fine. I think Mr. Bernanke's theory will probably lead to a spike in the price of islands in the Bahamas that you can buy as an individual, but that's the only way that the wealth effect is really going to have an impact. I think that's old school thinking.
Yeah.
But again, it's immaterial. Let's go.
Yeah, that's the old ivory tower college professor thing. Actually, no clue at all, in a bubble, because everyone, when he goes out to dinner or goes to his cocktail party, all owns stocks. But
that's right. That's right.
Reality is, such a significant amount of people own stocks that have it. It's not even significant. When you look at people who have an IRA with $10,000, so what if it goes up 10%?
That's right. It's not going to make you feel wealthier.
Exactly.
And Rich, it would be an interesting exercise to find out the percentage of Americans who own gold in some form versus those who own stocks. I've never seen that statistic, but it would be a good one for you guys to maybe try to dig up.
It's tiny. It's tiny.
Nevertheless, but I think that's a smart segment of the population who owns gold.
Amen.
But I want to go to the question of valuations. Somebody also asked, somebody said, are you saying we should get out of tech?
I was going to throw that in too. I was going to add that on.
With 4 question marks, which says incredulity. No. I think what the reality is that there are certain segments of the tech, you have to disaggregate tech. Certain parts of the tech market are overvalued dramatically. Amazon is one of them. And Amazon is I forget the current ratio, but it was over 100 not too long ago. And that's purely based on the expectation of future revenue growth. Now, in Amazon's case, that's probably justified. But in other cases, like with Zoom, where you have PE ratios over 400, they've got a lot of growing to do to catch up to that PE ratio. So I think the thing to do, what I mean to say is that there are parts of the tech market that are absolutely worth investing in. I'm very bullish on the cloud computing sector. I'm very bullish on what they call software as a service. The Bauman letter is invested in a number of companies that have made us triple-digit returns in less than a year in that sector, and they're continuing to grow because they provide genuinely useful products for which people are willing to pay. But there are a lot of companies that have become overvalued simply because people perceive that there is no other alternative. Companies like Apple, for me, Apple is wildly overvalued right now. In fact, I was talking to a guy who was working on my house, a builder. He was excited because he bought Apple just before it peaked. He said, "Do you think I made a good move?" I said, "Man," I said, "talk to me next week." And of course, it fell by like 20%. And that's because I think a lot of people look at the tech sector as being the big names. Yes, those big names, they're overvalued. But the little names, the ones that are making increasingly interesting and useful products that will change the world going forward, they are undervalued and growing rapidly. And to punt myself, what we do at the Bauman Letter is to look for them, and that's where we get our triple-digit gains.
And I just have to add, it's not a blanket statement. You either should be in tech or not.
Yeah.
I mean, because it's just like, remember, I mean, this was only a short time ago, the tech wreck of 2000.
Yeah.
The tech wreck came because there was a lot of companies that became ridiculous. Pets.com, right? Everyone's just started stamping .com and going to market. Well, I happened to work at one of the big players at the time who's only gotten bigger and bigger and bigger. So no, there was a lot of great tech companies, but the greed came in, that Wall Street nonsense, bringing everything public, because as long as it said .com on the name, you were able to sell the stocks. We're always going to be in those positions, and it's the same thing now. So you got to do your homework.
Yep.
Tech isn't going away. It's the driver behind almost everything. Everyone is incorporating more and more tech into their processes to become more efficient and more effective. So to Ted's point, you get a letter, you let guys do the research and find those, not the names that are in the headlines, the ones that are who are small, who are the ones who have the promising technology, and either will probably get real big real quick or get bought out, and you'll still make a lot of money. So they're there.
And just to add on to that, one of my golden rules of investing is that I would rather invest in the pick and shovels than in the miner, because I think what we find with a lot of companies is that or a lot of sectors rather, is that there are certain companies that provide things that make it possible for other technology-oriented companies to do what they do. I mean, a good example is the data center sector, the real estate investment trust, REITs that own data centers. I mean, tech companies will come and go, but they all need storage space on servers. And so I would rather own the server farms than I would, the tech companies. And that's a good rule of thumb in technology. Look for the background companies that provide the essential services that make all of this possible. So for example, cell towers. Cell towers is a huge bullish area for me, not because they have a great business model because of the economies of scale and all that kind of stuff. But at the end of the day, with 5G coming, if you can find the right companies that have the right assets, it doesn't matter which cell phone company is going to do well. It doesn't matter which cell phone people are using. They all need that cell tower company to do their business. So that's what I always look for.
Good point. I see three more questions that I think we've gotten to all of them. So we're going to wrap up with these. I'll take my stab at it, hand it off to you guys, and then we'll go around for final comments. One quick question, and I think this one falls into my area, is bullion versus numismatics. And we sell both. I'm a firm believer in having both in a portfolio, but my percentage of numismatics is much, much lower. I think now's a great time to consider that. You get the potential benefit with a numismatic coin of not just the floor, the gold content, but also the potential of increased, collectability, right? So people want it because there's only a few of them, and that has the potential at times to increase your potential return. So for me, that's more of a speculation. It is not your wealth insurance, okay? But I like them both, and I have them both. The other big one that comes out, and there were two questions about this, is ETFs. Somebody said, what about holding ETFs. Another one said, I hold my gold 5% in ETFs. I have a problem with that, to be honest with you. I think there's a better way. You can own physical gold, and nowadays you can own it very, very cost effectively, whether you take delivery or have it stored for you domestically or abroad. Why would you get something whose job it is? Why would you own shares in a trust? You're not owning any gold. You're owning shares in a trust whose job it is by the fund manager to replicate the price of gold. Why would you buy all that chaos with very, very little investor protections, by the way? Big protections for the trust, if you read the fine print. Very little protections for the investor. Why would you own that when you can own gold? You know, so I would absolutely rethink that posture. I like them. I think they've done a lot for the raising awareness. I think they have great implications for institutional buyers. It makes it a lot easier to take a position in that sector. But I think you can do better. And a lot of people don't even understand how they work. They don't understand why 1/10 of the gold price is never the price of a GLD share almost, because something's being managed there that they don't wrap their heads around. I use it when I sell something in my stock portfolio and I don't know what I want to buy next. I'd rather sit in that than dollars. But outside of that, I think there's a better way. Your thoughts?
Yeah, I would agree with you on that one. I think definitely if you want to buy gold, buy gold. Don't buy somebody's representation of gold. Having said that, though, I think that there is a role for the ETFs in playing short-term trends in the market. But again,
see, but even that, there are physical gold programs. We offer them, the Perth Mint Depository online. I mean, you can jump in and out for 1% or less in $50 increments. What the hell do you need GLD for?
That's right. That's exactly. I think you're right. I think. So it's like anything else. We've talked about the percentage of gold in your portfolio, but then you can talk about the percentages of your gold portfolio. Some of it's physical, some of it's maybe the Perth Mint, some of it is ETFs. So it really comes down to how you want to play it. But my basic thesis is that if you really want to play the gold markets on a short-term basis, you need a lot more expertise than I certainly have. I mean, Rich, you probably, I don't have it, and I've been doing investment for a long time. So I just think
I see it move up and down, but to predict it, that's a whole nother thing.
Well, exactly. So you might as well just buy the gold and be done with it.
Yeah, amen. Chris?
Yeah, I'll just say, first of all ETFs aren't created equal. If you look at their structures. Unfortunately for that one participant, I think if you were to read the prospectus on the risk portion, you would see that GLD is probably the least favorable to the investor of almost all ETFs out there.
Right.
So please read it, because you don't want to hear from me. You can Google it. You don't have to wait for it to get mailed to you yearly or whenever they do that. I'm in the camp, like what Ted said. To me, an ETF is, especially a GLD, is nothing but an easy way to be in a derivative. And if you're going to do short-term moves, if you want to play the market, you think there's a piece of news that's going to come up that's going to affect gold and it's going to pop. It's a good way for doing it. But it's really a derivative. That's it. It's just
not your wealth insurance.
Yeah, I mean, if you're not don't have an account, you don't have the ability to really go into futures and options. That's what GLD and SLB is for.
All right. Well, I think before we put everyone to sleep, okay, I think it's time to kind of wrap up here. Ted, I want to start out with you. If you can give just your parting thoughts of what you want people to take away in this current environment, and please tell them also how they can get a hold of your newsletter, Bauman Letter, and maybe you can mention a little something about what's going on YouTube with you as well.
Well, first of all, I would say I would reinforce what we've all said, which is that you need to treat gold as a special case in your investment. It is, like I said earlier, it's the canned soup in your survival bunker. It's you worry about it. You want to have it because when you need it, you want it to be there. That's why we own gold. Don't treat it as the way you treat your stocks. On the other hand, when it comes to stocks, I think right now things are unstable. There's a lot of up and down. We've seen volatility in the market recently, but I do think that the trend over the next year or so is going to be to move away from the high-flying tech stocks that are overvalued and you want to look for value in cyclicals and in undervalued companies that cater for the real world. We know that there's a lot of uncertainty around the COVID pandemic, but at the end of the day, what you want to bet on is the relative rate of change of stock prices over time in the future. The relative rate of change of the big tech stocks is not likely to be as fast as it has been recently. So look for value. In terms of where you can find me, www.banyanhill.com, BANYANHILL.com. Look for the Bauman letter. We look also for Profit Switch. That is my two products there. We have a new product coming out soon called Flashpoint Fortunes, which is an incredible options trading service that is based on predicting moves in the quant market, which has just an unbelievable return. In our back testing, 99% return on an average 36-day hold in options, both puts and calls. So we're doing very well. So I would encourage you to check us out.
Fantastic. What about YouTube? How do they find you on YouTube? At Banyan Hill as well?
YouTube, just a search for my name, Ted Bauman, TEDBAUMAN. On YouTube. I have a great channel. We have about 25,000 subscribers, very lively discussions. I tend to be unrestrained. I like to be controversial. I like to be able to say things that a lot of people are afraid to say. And I like to see people push back. I like to see people talk back in the comments section. We have very lively discussions in there.
I've been there. You definitely want to visit. There's no question. All right, Chris, your parting thoughts. What do you want to leave people with today?
Just want to thank all our attendees for coming. Really appreciate it. And great having another night with my friend Rich, and enjoyed working and having this conversation with Ted also. In our world of precious metals, folks, you have a lot of good questions. Before you make a purchase, you should really reach out to someone like Rich or myself and, and do a deep dive on these questions so you make what's most appropriate for your needs. I'd love you to learn more about us at Neptune Global. That's at neptuneglobal.com, and to look and learn more about the PMC ounce. As I said, it's a physical precious metals product. It actually buys and sells with the ease of like you're an ETF. It's all real time. You could just make a trade through the folks at ASI or Neptune. It's the same price. It doesn't matter. And it's a great way to have a true physical precious metals portfolio with each PMC ounce. So
I was going to say the fine print on the PMC ounce is wonderful. It means you own physically 100% your gold, silver, platinum, and palladium. So there's their fine print, and it's worth owning. Thanks, Chris. I just want to leave everybody with a couple things. First off, I think everybody kind of touched on, there are always opportunities in every environment, and when there's crisis, there's opportunity as well. So, no matter what shakes out over the next few weeks, there are ways for you to prosper, to protect your portfolio, et cetera. And in every scenario, in every equation, gold's a part of that. So to try and help you, encourage you to take that position, we're going to make a special offer to those of you who stuck around and listened tonight. We're offering 2020 gold American Eagles and 2020 gold Buffaloes, your choice, at just 6% over spot. It's a great rate for conference attendees. We're going to sweeten it a little further. If you buy 5 or more, we'll throw in a free Silver Eagle. You buy 10 or more, you get free shipping. So by all means, this will come out tomorrow as we send the copy of the video to everyone. You'll see all the contact information for Chris, for Ted, and for this offer. The very last thing I want to say up before I thank our guests and our attendees is, I don't know who said this. I wrote about it in our perspective just a few days ago, but this country is absolutely divided, and everybody's, this is a battle for the soul of the country. Are we going capitalism, socialism? Which direction? Where is America going to be in the future? In the end, and I don't know who said it, but I'm not going to stop from repeating it. In the end, it matters far less who's in the White House and what happens in the White House, as opposed to what happens in your house. Be your own shining example for your kids, for your family. Treat your enemies and your friends with respect. And we're going to get through this. I have full faith. I am an eternal optimist in the human spirit, and especially in the American spirit. So don't anybody give up hope, no matter how high the ammo prices go. I want to thank Chris, as always, wonderful spending time with you. Ted, absolutely worth the anticipatory time leading up to this. I was really, really looking forward to this night, and you haven't disappointed. And thanks to everybody that joined us. We look forward to seeing you again on January 19th, and we'll be reaching out to everyone as soon as we lock down what I hope will be very special guests. Thank you for attending.
Good night.
Night.